How are bonds faring with interest rates so low?
RCCN Sunrise Money Market segment star Bob McClure has the answer.
You know, the thing is, in the United States, there's more than 3 times as many dollars invested in bonds as there are invested in stocks. The reasons why so many people put their money in bonds is pretty obvious. They pay specific interest payments on set dates, and on a future date, they pay back your principal at maturity. Stocks, on the other hand, try to pay quarterly dividends, but they're not legally required to, and the stock price can obviously fluctuate, and there's no guaranteed payback period. So with this being said, bonds have a lot less risk. Therefore, they tend to have lower returns on a long-term basis. If we look at this first chart here, we see that if you bought a 30-year U.S. Treasury at the beginning of this year, you would have got something around 3.9% annual interest payment. That interest payment, if you bought that same bond today, would be down to about 3.1%. It's fallen about 22% over the course of the year. If you compare that to the gain in the S&P 500 of a positive 9%, you can see a pretty big disparity. But here's the thing you have to bear in mind. Just like housing prices, bond prices tend to rise and fall in the opposite direction of interest rates. So as interest rates has pushed down during the course of the year, the actual price of that bond that you bought on January 1st this year has probably risen quite a bit. Just like housing prices increase because you can buy more house as interest rates decline. So here's what's happened. That 30-year Treasury that paid you 3.9% at the beginning of this year, interest rates have dropped. It has actually risen in value 17%. In addition, you tack on the year-to-date earnings, which is probably about 3%. You've made about 20% on your money, more than twice as much as if you had invested in stocks. So while we've heard a lot about the Fed pushing interest rates down and the low interest rates that investors in bonds have received, the actual bond investor who bought and held the very risky 30-year Treasury has done quite well. Now, here's the problem. In the months going forward, or years going forward, as the Federal Reserve starts to push interest rates up, bond investors could suffer substantial losses. When that'll happen, or if it happens, and to what degree, we'll have to stay tuned. Paolo, Sunita?
Well, we are staying tuned for that, Bob, so you'll let us know when it's time to cry Mary.
Yeah, I'll keep an eye on my crystal ball and let you know.
Okay, sounds good.
All right, great.